Before we begin, please remember that I am not a licensed financial advisor, and this presentation is for informational and educational purposes only. The information provided is not intended to be a substitute for professional financial advice. Always consult with a qualified financial professional before making any decisions about your mortgage or personal finances. Your financial situation is unique, and any action you take upon the information in this video is strictly at your own risk. Let me tell you about a couple from Texas, Mark and Jessica. They bought their dream home a few years ago with a 6.5% interest rate. Every month they'd look at their mortgage statement, a $2,800 payment, and feel a pit in their stomach. It was their single biggest expense, a financial anchor holding them back from saving for their kids' college, from taking a real vacation, from just breathing a little easier. They felt trapped. They assumed this was just the cost of homeownership in America. Then a friend mentioned refinancing. Mark and Jessica were skeptical. They imagined mountains of paperwork, hidden fees, and a complicated process designed to confuse them. But they made one phone call. Just one. An hour later, they had a clear path to lock in a new rate under 5%. That one phone call is now saving them over $450 every single month. That's over $5,000 a year. And over the life of their new loan, it will save them more than $160,000 in interest. $160,000. That's a brand new Porsche. That's an entire college education. That's a life-changing amount of money they almost paid to their bank, simply because they didn't know they had another option. The truth is, millions of American homeowners are in the exact same position as Mark and Jessica. You might be one of them. You might be looking at your mortgage statement right now, feeling that same weight, that same sense of being stuck. You're making your payments on time, you're doing everything right, but you have this nagging feeling that you're overpaying, that your hard-earned money isn't working as hard as it could be. The mortgage industry can feel like a maze, intentionally designed with confusing language, complex terms, and a process that feels overwhelming. They count on you being too busy or too intimidated to ask the right questions. But what if you could cut through all that noise? What if you could understand, in plain English, exactly how this powerful financial tool works? That's why we're here. In this video, I'm going to pull back the curtain on mortgage refinancing. We're not just going to define it, we're going to arm you with a simple, clear framework to determine if and when it makes sense for you. By the end of this, you will have the confidence to look at your own mortgage and know, without a doubt, whether you're leaving money on the table. We're going to transform that feeling of uncertainty into a feeling of control over your single biggest asset and your single biggest monthly expense. So let's start at the very beginning. What is a mortgage refinance? Forget the bank jargon. At its core, it's incredibly simple. A refinance is the process of replacing your existing home loan with a new one. That's it. You're essentially trading in your old mortgage for a new, better one. The new loan pays off the old loan's balance, and you start making payments on the new loan instead. Think of it like this. Imagine you bought a car 5 years ago and got a car loan with a 7% interest rate. Today, your credit is better and interest rates have dropped. You wouldn't keep paying that old 7% loan, would you? Of course not. You'd go to a bank or a credit union and get a new loan at 4% to pay off the old one, saving you money every month. A mortgage refinance works on the exact same principle, but because the numbers are so much bigger, the potential savings are absolutely massive. People refinance for many reasons, but almost all of them fall into one of three major categories. Understanding these three goals is the first step to figuring out if a refi is right for you. The first and most common reason is to lower your interest rate and, by extension, your monthly payment. This is the classic scenario, just like with Mark and Jessica. Interest rates are constantly changing. They go up, they go down. If you got your mortgage when rates were higher than they are today, you are a prime candidate for a refinance. Even a small drop in your interest rate can have a colossal impact. Let's run some simple numbers. Say you have a $400,000 mortgage on a 30-year fixed loan at 6%. Your monthly principal and interest payment is about $2,398. Now, let's say you can refinance that same $400,000 balance into a new 30-year loan at 5%. Your new monthly payment would be about $2,147. That's a savings of $251 every single month. That's over $3,000 a year. But here's where it gets really staggering. Over the 30-year life of that loan, you would save over $90,000 in total interest payments. $90,000. All for securing a rate that's just 1 percentage point lower. This is the number one reason people refinance. to reduce the cost of borrowing money and free up cash flow month after month. The second major reason to refinance is to change the term of your loan. The term is simply how long you have to pay the loan back, most commonly 30 years or 15 years. Each has a major advantage. Many people refinance from a 30-year mortgage into a 15-year mortgage. Why would they do that? Well, a shorter loan term almost always comes with a lower interest rate, and more importantly, you pay the loan off in half the time. This means you build equity, the part of the home you actually own, at lightning speed, and the interest savings are astronomical. Let's go back to that $400,000 loan. We saw that at 5% on a 30-year term, you'd pay about $373,000 in total interest. If you refinanced into a 15-year term, you might get a rate of 4.5%. Your monthly payment would be higher, around $3,060, but your total interest paid would only be about $151,000. By choosing the 15-year option, you would save over $220,000 in interest. You'd own your home free and clear 15 years sooner. On the flip side, some people need to lower their monthly payment as much as possible. Maybe they've started a family, or their income has changed. They might refinance from a 15-year loan back to a 30-year loan. Their monthly payment will drop significantly, providing immediate financial relief, even if it means paying more interest over the long run. It's about changing the loan's timeline to better match your life's financial timeline. Finally, the third major reason is to tap into your home's equity. This is what's called a cash-out refinance. Your home equity is the difference between what your home is worth and what you still owe on your mortgage. For example, if your home is valued at $500,000 and you owe $300,000, you have $200,000 in equity. A cash-out refinance lets you take out a new, larger mortgage and receive the difference in a lump sum of tax-free cash. So, in our example, you might get a new loan for $350,000. That loan pays off your old $300,000 mortgage, and you get a check for $50,000. People use this cash for all sorts of things: to pay for a major home renovation, to consolidate high-interest debt like credit cards or personal loans into one lower-interest mortgage payment, or to pay for a child's college tuition. It can be an incredibly powerful and strategic tool, allowing you to use the value you've built in your home to achieve other major financial goals. It essentially turns your house into a source of accessible capital. However, it also comes with its own set of risks, because you are increasing the total amount of debt you have secured against your home, lowering your rate, changing your term, or tapping into your equity. These are the three strategic pillars of refinancing. And now that you understand the why, we can begin to dig into the critical next question. How do you know if the timing is right for you? The most common trigger, the one that gets everyone's attention, is a drop in interest rates. It's the headline grabber. You see it on the news, you hear your coworkers talking about it at the water cooler. Rates are down. It feels like a national holiday for homeowners. But seeing that headline and knowing if it's the right move for you are two completely different things. The gap between those two is where people make costly mistakes. So let's start with the most popular reason to refinance: securing a lower interest rate to reduce your monthly payment. This is the classic bread and butter refi. Imagine you bought your home in late 2023. You were thrilled to get into the market, but you had to swallow a tough pill: an interest rate of, say, 7.25%. At the time, it was the cost of doing business. But now, a year or two later, the economic winds have shifted. The Federal Reserve has changed its policy, and mortgage rates have fallen to 5.75%. That 1.5-point drop feels like a beacon of hope. Your phone starts buzzing with ads from lenders promising you incredible savings. But what does that 1.5% actually mean for your wallet? Let's break it down with real numbers, because that's where the truth lives. Let's say your original loan was for $400,000 on a 30-year fixed term at that 7.25% interest rate. Your monthly principal and interest payment would be roughly $2,728. Now let's say you can refinance the remaining balance. We'll keep it simple and say it's still close to $400,000 into a new 30-year loan at 5.75%. Your new monthly payment for principal and interest drops to about $2,334. That's a difference of $394 every single month. Think about what that is. That's a car payment. That's your family's entire grocery bill for the week. That's a significant chunk of a student loan payment. Over the course of a year, that's over $4,700 back in your pocket. Multiply that by the 30-year life of the loan, and you're looking at a potential savings of over $140,000 in interest. That is a life-changing amount of money. It's the difference between retiring comfortably and working an extra decade. It's a college education for your kids. It's freedom. When you see numbers like that, it's easy to get excited and think, where do I sign? And this is the exact moment where you need to take a deep breath and slow down. Because lenders, in their excitement to win your business, often leave out the most important part of the equation: the cost. Refinancing isn't free. You're essentially taking out a brand new mortgage to pay off your old one, and that process comes with closing costs just like when you first bought your house. These can include application fees, appraisal fees, title insurance, attorney fees, and more. Typically, you can expect closing costs to be anywhere from 2% to 5% of your total loan amount. So, on that $400,000 refinance, you could be looking at costs between $8,000 and $20,000. Suddenly, the decision isn't so simple, is it? That money has to come from somewhere. You can either pay it out of pocket, which is a big check to write, or you can roll it into the new loan. Most people choose to roll it in. But if you do that, you're now borrowing more money, which slightly increases your new monthly payment and eats into your overall savings. This is where we get to the single most important calculation you will make in the entire refinancing process. It's called the break-even point. And if you learn nothing else from this video, learn this. The break-even point tells you the exact number of months it will take for your monthly savings to cover your closing costs. The formula is incredibly simple. Total closing costs divided by your monthly savings. That's it. Let's go back to our example. Your monthly savings are $394. Let's say your closing costs came in at a reasonable $10,000. So you take $10,000 and divide it by $394. The answer is 25.3. This means it will take you just over 25 months, a little more than 2 years, of living in that house and making that new lower payment to break even. After month 25, every single dollar you save is pure profit, pure financial gain. Now, here's the critical question you have to ask yourself with brutal honesty. How long am I realistically going to be in this house? Because if you think there's a good chance you might get a job transfer, need to upsize for a growing family, or decide to move to a different city within the next 2 years, then refinancing would be a catastrophic financial mistake. You would spend $10,000 on closing costs, only to sell the house before you ever recoup that money. You would have literally thrown away 10 grand. I know a couple, let's call them Mark and Sarah. They had a 6.5% rate and saw an opportunity to refinance down to 5%. The math looked great on paper. They'd save about $350 a month. The closing costs were $9,000. Their break-even point was about 26 months. They thought, of course we'll be here for more than 2 years. We love this house. They signed the papers, celebrated their lower payment, and felt incredibly smart. 14 months later, Sarah got an unexpected dream job offer. The catch? It was 3 states away. It was an opportunity they couldn't pass up. They had to sell the house. They had only saved about $4,900 from their lower payments, but they had spent $9,000 to get them. They ended up losing over $4,000 on the deal. They walked away from that refinance poorer than when they started, all because they didn't accurately predict their future. Their story is a cautionary tale. The break-even point isn't just a financial calculation. It's a life calculation. It forces you to look beyond the immediate thrill of a lower payment and consider your long-term plans. The old rule of thumb used to be that you should only refinance if you can lower your rate by at least 1% to 2%. But that's outdated advice. With a large enough loan, even a 0.5% drop can save you a substantial amount of money and lead to a reasonable break-even point. Conversely, even a 2% drop might not make sense if the closing costs are sky-high, and you plan on moving soon. So, your first step is not to call a lender. It's to sit down at your kitchen table and have an honest conversation. Where do you see yourself in 1 year? 3 years? 5 years? 7 years? If the answer is right here in this house, and your break-even point is well within that time frame, then you have a green light. You have a powerful data-driven reason to believe that refinancing to a lower rate is a winning strategy for you. But lowering your payment is only one piece of the puzzle. What if rates haven't dropped much but your income has gone up? What if your priority isn't saving a few $100s a month, but achieving the ultimate American dream? Owning your home free and clear, years ahead of schedule. That brings us to the second strategic pillar of refinancing: changing your loan term. And this is where you can stop playing defense with your money and start playing offense, building wealth at an accelerated pace. Let's talk about that offense. Most Americans think of their mortgage as a purely defensive financial product. It's a bill, a liability, a 30-year ball and chain they drag around until one day it finally falls off. But a small, savvy group of homeowners sees it differently. They see their mortgage not as a liability, but as a strategic tool for wealth creation. And their number one play is shortening the loan term. The most common version of this move is refinancing from a traditional 30-year mortgage into a 15-year mortgage. Now right away your brain might be screaming, wait, a 15-year loan? Isn't the monthly payment way higher? And yes, it absolutely is. We're not going to sugarcoat that. But what you pay for in monthly cash flow, you gain back tenfold in wealth-building velocity. Let's make this real. Imagine a family. Let's call them the Millers. 5 years ago, they bought their dream home with a $400,000, 30-year fixed-rate mortgage at 6.5%. Their monthly principal and interest payment is about $2,528. For 5 years, they've paid it on time every time. Now, their loan balance is down to about $375,000. They've built up some equity and their incomes have grown. They feel more financially secure. They look at the current market and see they can refinance. They have two main options. Option A is to refinance their $375,000 balance into a new 30-year mortgage at a lower rate, let's say 5.5%. Their new monthly payment would be about $2,129. Hey, that's almost $400 a month in savings. That sounds great, right? It's playing defense. It's a good move that frees up cash. But the Millers want to play offense. So they look at option B, refinancing that same $375,000 into a 15-year mortgage. Because 15-year loans are less risky for banks, they often come with even lower interest rates. Let's say they get a rate of 5%. Now their new monthly payment jumps up to $2,964. That's over $400 more than they were paying originally. This is the moment where 9 out of 10 people walk away. But the Millers are the 1 in 10. They do the math. If they stick with their original 30-year loan, over its entire life, they will pay a staggering $500,000 in interest alone. That's more than the house itself cost. If they take option A, the new 30-year loan, they'll pay less interest from this point forward. But because they've reset the clock back to 30 years, their total interest paid will still be massive. But with option B, the 15-year loan, the total interest they will pay over those 15 years is just about $158,000. Let me say that again. By choosing the higher monthly payment, they will save hundreds of thousands of dollars in interest payments. That is not a typo. That is a life-changing amount of money. That's a college education for 2 kids. It's a rental property that generates passive income for the rest of their lives. It's the difference between retiring at 65 and retiring at 55. Every single month, that higher payment is not just disappearing into the bank's coffers. It is a direct injection of equity into their home. It's a forced savings and investment plan with a guaranteed return. They are systematically converting their income into net worth at an incredible speed. They'll be completely mortgage-free in 15 years, just as their kids might be heading to college, freeing up thousands of dollars a month right when they need it most. This is what playing offense looks like. It requires discipline. It requires a stable income. It's not for everyone, but for those who can make it work, it is one of the most powerful and reliable wealth-building strategies available to the American middle class. But what if you're on the other side of the coin? What if life throws you a curveball? What if instead of your income going up, it goes down? What if a spouse loses a job, a medical emergency strikes, or you decide to start a business and cash flow is suddenly tight? This is when you need to switch from offense back to defense, and changing your loan term can be a financial lifeline. This is where you might consider lengthening your loan term. Let's rewind. Imagine the Millers had originally started with a 15-year mortgage. They were aggressive from day one, but now Mr. Miller's company has downsized, and his income is cut in half. That high mortgage payment that once felt like a smart investment now feels like an anchor, pulling them under. They're struggling to make ends meet. This is a textbook scenario for refinancing to lengthen the term. They could take their remaining loan balance and refinance it into a 20, 25, or even a new 30-year mortgage. Yes, the interest rate might be a little higher. And yes, they will absolutely pay far more in total interest over the life of the new loan. We have to be brutally honest about that. This is not a wealth-building move. This is a financial survival move. By stretching the payments out over a longer period, they could potentially slash their monthly housing costs by $800, $900, or even $1,000. That's not just a little breathing room. That's the difference between keeping their home and facing foreclosure. It's the money they need for groceries, for gas, to keep the lights on while they get back on their feet. Lengthening your loan term is a pressure release valve. It's a way to trade long-term interest costs for immediate, critical monthly cash flow. You're consciously choosing to pay the bank more in the long run in exchange for the stability you desperately need right now. It's a powerful tool, but one that should be used with caution and a clear understanding of the trade-off. Now, this brings us to a fascinating and underutilized hybrid strategy. It's for the person who wants the best of both worlds, the wealth-building power of a 15-year mortgage with the safety net of a 30-year. How is that possible? Simple. You refinance into a 30-year fixed-rate loan to lock in the lowest possible required monthly payment. This is your safety net. If life goes sideways, you know you can always afford this lower baseline payment. But, and this is the crucial part, you commit to paying it like it's a 15-year loan. You go online, you use a mortgage calculator, and you figure out what the monthly payment would be for a 15-year term at your same interest rate. Then, every single month, you pay that higher amount, making sure the extra money is designated to go directly toward your principal balance. What does this accomplish? First, you achieve the exact same result as a 15-year mortgage. You will pay off your house in 15 years and save a fortune in interest. You are playing offense. Second, you retain complete flexibility. Let's say one month the air conditioner dies and you have a surprise $5,000 bill. No problem. That month, you simply pay the lower required 30-year payment. You don't have to call the bank, you're not late, there's no penalty. You just absorb the financial shock and get back on track the next month. It is financial discipline combined with a built-in emergency plan. The only catch? It requires actual discipline. The bank isn't forcing you to make that higher payment. You have to force yourself. And frankly, most people don't have that level of consistency. They'll make the extra payments for a few months, but then a vacation comes up, or a new car looks appealing, and that extra money gets redirected. But if you are the kind of person who can set up an automatic payment for the higher amount and not touch it, this hybrid strategy offers an incredible combination of aggressive wealth building and conservative financial protection. So, when you think about refinancing, don't just ask what the new rate is. Ask what the new term is and what that term can do for you. Are you in a position to play offense, shortening your term to build equity at lightning speed and free yourself from debt decades early? Or do you need to play defense, lengthening your term to create the monthly cash flow you need to weather a storm? Understanding this choice between time and money is at the very heart of a strategic refinance. But we've only been talking about changing the terms on the money you already owe. What if you could use a refinance to pull out brand new money, tapping into your home's equity like a personal bank? This is where things get really powerful and potentially really dangerous. This is the world of the cash-out refinance. So what is this powerful, dangerous tool? Think of your home's equity as money stored in a vault. For years, you've been making deposits through your mortgage payments, and the value of the vault itself has been growing thanks to the housing market. A cash-out refinance is like getting a special key that lets you open that vault, take out a big pile of cash, and then lock it back up with a new, bigger loan attached to it. Let's break that down. You're not just getting a new mortgage for the amount you still owe. You're getting a new mortgage for what you owe plus an extra amount that you get to keep in cash. That cash is the equity you've built up. Feels like free money. Feels like you've hit the jackpot. But I promise you, it is one of the furthest things from free money that exists in the financial world. It is a loan, plain and simple, and the collateral is the roof over your head. How you use that money is the dividing line between a brilliant financial move and a catastrophic mistake. To see this in action, let's imagine two neighbors, Mark and Sarah. They live in identical houses, bought them around the same time, and have roughly the same financial picture. Their homes are now worth $600,000. They both have an outstanding mortgage balance of $300,000. This means they each have a whopping $300,000 in home equity. Both Mark and Sarah see this number on a statement and their eyes light up. They both decide to do a cash-out refinance. And this is where their stories diverge dramatically. First, let's look at Mark. Mark has about $30,000 in credit card debt that's been haunting him for years. The interest rates are brutal, hovering around 24%. He's paying over $600 a month just on interest, feeling like he's running on a treadmill, getting nowhere. He also has 2 kids approaching college age, and the thought of tuition is keeping him up at night. Mark goes to a lender. The lender tells him they'll approve a cash-out refinance for up to 80% of his home's value. This is a key number. 80%. Lenders almost never let you borrow 100% of your equity. They need a cushion, a safety net in case the market turns. So, 80% of his $600,000 home is $480,000. That's the maximum new loan he can get. Mark doesn't need that much. He decides to take out a new loan for $400,000. Here's how the money moves. First, the new $400,000 loan completely pays off his old $300,000 mortgage. That original loan is gone forever. The remaining $100,000 is then wired directly into his bank account. Tax-free. The moment it hits his account, Mark executes his plan. He takes $30,000 and pays off every single one of his high-interest credit cards. Instantly, that 24% interest rate nightmare is gone, replaced by the much lower rate of his new mortgage. Let's say it's 6.5%. He just swapped toxic, expensive debt for cheaper, more manageable debt. The remaining $70,000? He puts it into a high-yield savings account, specifically earmarked for his kids' college education. He's not going to touch it. He's not going to buy a new TV. He's not going to book a vacation. He used his house to solve a major financial problem and secure his family's future. His new mortgage payment is higher than his old one, yes, but the amount he's saving on credit card interest more than makes up for it. Mark used the cash-out refinance as a strategic tool. Now let's walk across the street to Sarah's house. She has the exact same opportunity. Same equity, same 80% rule. She also gets a check for $100,000. But Sarah's mindset is different. She sees this as house money, a bonus, a prize for being a homeowner. The first thing she does is buy a brand new luxury SUV for $65,000. She's always wanted one, and now she can just buy it. No car loan, no monthly payments. Feels amazing. Then she decides the family deserves a once-in-a-lifetime trip to Hawaii. That's another $15,000. She renovates the master bathroom not because it needs it, but because she saw a design she loved online. Another $20,000. In a matter of months, the $100,000 is gone. And what does she have to show for it? A vehicle that lost thousands of dollars in value the second she drove it off the lot. Photos from a great vacation. And a nice bathroom. But her financial reality has fundamentally changed for the worse. Her mortgage balance just jumped from $300,000 to $400,000. She has reset the clock on her home loan, meaning she'll be paying it off for another 30 years. Her monthly payment is significantly higher, squeezing her budget every single month. She effectively traded a huge chunk of her financial security, her home equity, for things that lose value. She turned her most valuable asset into a depreciating car and a memory. This is the danger. The cash-out refinance makes it incredibly easy to turn solid, wealth-building home equity into thin air. And there's an even bigger risk we need to talk about, and it goes back to Mark's story. Remember how he paid off his credit cards? That sounds like a clear win. But he performed a kind of financial alchemy that can be incredibly dangerous if you're not careful. He took unsecured debt, the credit card debt, and transformed it into secured debt. What does that mean? If you default on your credit card payments, the credit card company can ruin your credit, they can sue you, they can harass you with phone calls. But they cannot come to your house and take it. It's unsecured. Your mortgage, however, is secured by your house itself. By moving his debt from the credit card to the mortgage, Mark has now put his home on the line for that $30,000. If he loses his job and can't make his new, higher mortgage payment, the bank won't just sue him. They will foreclose. They will take his home. This is the ultimate trade-off. It's a brilliant move if, and only if, you have the discipline to never let that high-interest debt come back. If Mark goes out and racks up another $30,000 on those same credit cards, he will be in a financial hole so deep he may never get out. He'll have the old debt back, plus a much larger mortgage. It's a trap that has destroyed countless American families. And finally, there's the one thing nobody likes to talk about, the costs. A cash-out refinance is a brand new mortgage, which means you have to pay brand new closing costs. These are typically 2% to 5% of the total loan amount. Not just the cash you're taking out. The whole thing. For Mark and Sarah's $400,000 loan, that means they had to pay between $8,000 and $20,000 in fees. That money is usually just rolled into the new loan so you don't feel it up front. But it's there. You're essentially paying thousands of dollars for the privilege of borrowing your own equity. So the cash-out refinance is the ultimate double-edged sword. Used with a clear, strategic purpose like Mark, who invested in his family's future and eliminated high-interest debt, it can be a life-changing financial tool. but used as a personal ATM for lifestyle upgrades like Sarah, it's a fast track to financial ruin, increasing your debt, stripping your equity, and putting your single greatest asset at risk. The question you have to ask yourself is not, can I do this? But why am I doing this? Is it to acquire an asset or to fund a lifestyle? The answer to that question will determine everything. But what if you have that amazing 2.75% interest rate from a few years ago? Giving that up for a new rate of 6.5% feels insane even if you need cash. What if there was a way to tap into your equity without touching your primary mortgage? There is. And it involves two options that act more like a credit card and a personal loan, using your home as the backstop. These are the cash-out refinance less disruptive, more flexible cousins, the HELOC and the home equity loan. Let's break them down, because understanding the difference is the key to unlocking your home's value without making a catastrophic mistake. Think of it this way. A cash-out refinance is like completely demolishing and rebuilding your financial house to add a new room. It's a major project. A home equity loan, on the other hand, is like building a separate, fixed-size guest house in your backyard. And a HELOC? That's like getting a special debit card that's directly linked to a bank account funded by your home's value. Three very different tools for three very different jobs. Let's start with the guest house. The home equity loan. This is probably the most straightforward of the two. You go to a lender, they approve you for a specific amount of money based on your equity, and they give you that money in one single lump sum payment. Boom! $50,000, $75,000, whatever you qualified for, is now in your bank account. This is a second mortgage. You now have your original primary mortgage payment, and you have a new separate monthly payment for this home equity loan. The major advantage here is predictability. Home equity loans almost always come with a fixed interest rate. So, that $50,000 loan might have a 10-year term and an 8% interest rate. You will know down to the penny what your payment will be every single month for the next 120 months. It will never change. This makes it an absolutely fantastic tool for large, one-time known expenses. You need exactly $60,000 to completely remodel your kitchen, and you have the contractor's quote in hand? A home equity loan is a strong contender. You know the cost, you get the exact amount, and your payment is locked in. No surprises. But there are downsides. You are now juggling two separate mortgage payments, which can be a mental burden. And while closing costs are typically lower than a full refinance, they still exist. You might pay a couple $1,000s in origination fees, appraisal fees, and other costs just to get the loan. The biggest drawback, though, is that you start paying interest on the entire loan amount from day one. Even if you only need $10,000 of that $60,000 for the deposit on your kitchen cabinets this month, you're already paying interest on the full $60,000 sitting in your savings account. It's not very efficient for projects with staggered costs. Now let's look at the other option, the more flexible, more dynamic, and frankly more dangerous cousin, the home equity line of credit or HELOC. This doesn't work like a loan at all. It works like a credit card. A lender approves you for a maximum credit limit, say $100,000, based on your equity, but they don't give you any money up front. Instead, they give you a way to access that money as you need it, usually with a special checkbook or a debit card. This is where the HELOC shines. For that kitchen remodel, instead of taking out a $60,000 loan all at once, you could use your HELOC. You pay the cabinet maker his $10,000 deposit. Now, you only owe $10,000 and you're only paying interest on that $10,000. Next month, you pay the plumber $5,000. Now you owe $15,000. You see? You draw what you need when you need it, and your interest is calculated only on your outstanding balance. It's incredibly flexible. HELOCs typically have two phases. The first is the draw period, usually lasting about 10 years. During this time, you can borrow from your credit line and pay it back as you please. Often, the required payments are interest-only, which makes them seem incredibly low and affordable. You can borrow $50,000 and have a monthly payment of just a few $100s. After the draw period ends, the loan enters the repayment period, which can be another 10 to 20 years. At this point, you can no longer borrow money. Your credit line is frozen, and you must begin paying back the principal plus the interest on whatever balance you have. This is where people get into trouble because that low, interest-only payment suddenly jumps, sometimes doubling or tripling, into a fully amortized payment. It's called payment shock, and it's a very real danger. The other massive risk with a HELOC is the interest rate. Unlike the fixed-rate home equity loan, the overwhelming majority of HELOCs have a variable interest rate. It's tied to a benchmark, like the prime rate set by the Federal Reserve. So, when you hear on the news that the Fed raised interest rates, that means the interest rate on your HELOC balance is about to go up too. Your monthly payment is not stable. Over a 10-year draw period, a rate that started at an attractive 5% could easily climb to 9%, 10%, or even higher, dramatically increasing your costs. So let's put it all together. When does one make more sense than the other? Let's run the scenarios. Scenario A. You need a very specific amount of money for a one-time project, and you value predictability above all else. You're putting on a $75,000 addition to your home. The home equity loan is your winner. You get the lump sum, your rate and payment are fixed for the life of the loan. You can budget perfectly. Scenario B. You need access to funds for ongoing, unpredictable expenses. Maybe you're starting a small business and need capital for inventory as it comes up. Or you want a financial safety net for emergencies. A rainy day fund on steroids that you don't have to touch unless you absolutely need to. The HELOC is the undisputed champion here. Its flexibility is unmatched. You only pay for what you use, and it can sit there with a zero balance for years, costing you nothing, acting as your ultimate emergency fund. But where does the cash-out refinance we talked about earlier fit in? Scenario C. This is the golden scenario. Let's say your current mortgage is at a 6.5% interest rate from a few years ago. But today, market rates have dropped to 4.5%. You also need $50,000 for a down payment on an investment property. This is the perfect storm for a cash-out refinance. Why would you keep your 6.5% mortgage and then take out a second loan, a home equity loan or HELOC, at an even higher 8% or 9%? It makes no sense. With a cash-out refinance, you can solve both problems at once. You replace your entire old mortgage with the new, larger one at the lower 4.5% rate. You pull out your $50,000 in cash, and because the new rate is so much lower than your old one, your new single monthly payment might be very similar, or in some cases even lower than what you were paying before on just the old mortgage alone. You get the cash and you improve your overall financial position. The most important thing to remember, the absolute non-negotiable truth about all three of these options, cash-out refi, home equity loan, and HELOC, is that you are borrowing against your home. This isn't an unsecured personal loan or credit card debt. Your house is the collateral. If you fail to make the payments for any reason, the lender can and will foreclose on your home. You will lose it. The flexibility of a HELOC can be a siren song, tempting you to use your home equity like a personal ATM for vacations, cars, and dinners out. This is a path to financial ruin. Tapping into your home's equity should be reserved for strategic investments that either increase the value of your home or improve your long-term financial health. It's a powerful tool, but one that demands immense respect and discipline. So we've covered the complex world of pulling cash out of your home. But what if you don't need cash? What if your only goal is to attack that interest rate, lower your monthly payment, or change how long you'll be paying your mortgage? That's where the most common and often most powerful type of refinance comes into play: the rate and term refinance. Think of the rate and term refinance as the classic, the original, the workhorse of the mortgage world. It's the simplest and most direct tool for homeowners. Its mission is laser-focused on two things: changing your interest rate, changing your loan term, or, in many cases, doing both at the same time. There's no cashing out, no equity pulling, no complex financial maneuvering. It is a clean swap. You trade your old, less favorable mortgage for a new, better one. Let's bring this to life. Meet Sarah and Tom. A few years ago, they bought their first home. They were thrilled, but the market was tough. Interest rates were hovering around 7%. They managed to get a 30-year fixed mortgage for $350,000 at a 6.8% interest rate. Their principal and interest payment every month comes out to roughly $2,281. 4 years they've paid it on time, building a little equity, living their lives. It's a significant chunk of their income, but it's manageable. Then one morning, Tom is scrolling through the news on his phone while waiting for his coffee to brew. He sees a headline: "Mortgage rates tumble to 2-year lows." He clicks. The article talks about rates now being in the low 5% range for qualified borrowers. A light bulb goes off. He shows the article to Sarah. Their 6.8% rate suddenly feels like an anchor, holding them back financially. That $2,281 payment, which they had accepted as a fact of life, now seems unnecessarily high. This is the moment for millions of Americans when the idea of a refinance is born. Their goal is simple. They want to lower that monthly payment. They want more breathing room in their budget. Maybe they want to save more for retirement, start a college fund for their kid, or just feel less financial pressure at the end of the month. So they make a call to a lender. The lender runs the numbers. With their excellent payment history and the fact that their home has appreciated in value, they now qualify for a new 30-year fixed mortgage at a 5.3% interest rate. Let's do the math on that. A new $350,000 loan at 5.3% for 30 years results in a new monthly principal and interest payment of about $1,943. Let that sink in. By making a few phone calls and signing a new set of documents, Sarah and Tom can reduce their monthly housing costs by $338. Every single month, that's over $4,000 a year. $4,000 that can now be used for investments, for vacations, for paying down other debt, for peace of mind. This is the incredible power of a rate and term refinance when the market moves in your favor. It's a direct financial stimulus package you give to yourself. But hold on. Anyone who's ever bought a house knows there's no such thing as a free lunch. The lender doesn't just swap your old loan for a new one out of the goodness of their heart. Refinancing is creating an entirely new loan, which means you have to pay closing costs, just like you did when you first bought the house. This is the single most important factor to understand, and it's where most people get tripped up. These costs can include an appraisal fee to confirm the home's current value, a title search and insurance to make sure ownership is clear, loan origination fees for the lender who is processing the loan, and other miscellaneous administrative costs. A good rule of thumb is to expect closing costs to be somewhere between 2% and 5% of the total loan amount. For Sarah and Tom's $350,000 loan, let's say the closing costs come out to 3%, which would be $10,500. Now that's a big number. Seeing that figure can cause a lot of people to slam on the brakes. They think, wait a minute, I'm trying to save money, not spend 10 grand. And this is where we need to introduce the most critical calculation in the entire refinance decision: the break-even point. The break-even point is your North Star. It tells you exactly how long it will take for your monthly savings to pay back the closing costs. The formula is beautifully simple. Total closing costs divided by your monthly savings. For Sarah and Tom, it looks like this: $10,500 in closing costs divided by their $338 in monthly savings. The result is 31.06. This means it will take them just over 31 months, or about 2.5 years, to recoup the cost of the refinance. After that 31-month mark, every single dollar they save is pure, unadulterated financial gain. This calculation transforms the decision. The question is no longer, is it worth spending $10,500? The question becomes, are we planning to stay in this house for longer than 31 months? If the answer is yes, then the refinance is a mathematical slam dunk. If they think they might move in a year or two for a new job, then it's a terrible idea. They would have spent all that money on closing costs only to sell the house before they ever saw a dime of real savings. The break-even point provides the clarity you need to make an informed, confident decision. Now let's look at the other lever we can pull in a rate and term refinance: the term itself. This is where you can fundamentally change your financial future. Let's stick with Sarah and Tom. They're saving $338 a month by refinancing into a new 30-year loan. That's great, but they're also financially disciplined. They sit down and have a serious talk. What if, Sarah asks, instead of lowering our payment, we tried to pay off the house faster? They call their lender back and ask about a 15-year mortgage. Because 15-year loans are less risky for banks, they often come with even lower interest rates. The lender tells them they can get a 15-year fixed rate at 4.8%. Now the math gets really interesting. A $350,000 loan at 4.8% over 15 years results in a monthly payment of $2,735. Wait a second. Their original payment was $2,281. This new payment is almost $455 higher per month. On the surface, this looks like a bad deal. Why would anyone voluntarily increase their monthly mortgage payment? The answer lies in one word: interest. Over the life of their original 30-year, 6.8% loan, Sarah and Tom were scheduled to pay a staggering $471,000 in interest alone. That's more than the entire cost of the house itself. Now look at the 15-year loan. Even with the higher monthly payment, because they're paying it off so much faster, the total interest they'll pay over the life of the loan is only about $142,000. By choosing the 15-year refinance, they would save over $329,000 in interest payments. Let me repeat that. Over $329,000. That is a life-changing amount of money. It's the difference between retiring at 60 versus 70. It's paying for multiple college educations outright. So you see, the rate and term refinance presents a powerful choice, a fork in the road. Path 1 is refinancing from a 30-year to another 30-year. This path is about improving your monthly cash flow. It's about creating breathing room in your budget right now. Path 2 is refinancing from a 30-year to a 15-year. This path is about aggression. It's about building equity at lightning speed and achieving total financial freedom from a mortgage decades sooner, saving a fortune in the process. Neither path is inherently right or wrong. The best choice depends entirely on your personal financial situation and your long-term goals. Are you in a season of life where you need more cash on hand every month? Or are you in a position to be aggressive, to sacrifice a little cash flow now for immense wealth building down the road? The rate and term refinance gives you the power to make that choice, to align your single biggest debt with what you truly want to achieve in life. But understanding the what and the how is only half the battle. The other half, and arguably the more important part, is the when. Timing is everything. How do you know if your FICO score is high enough to get those top-tier rates? How much equity do you actually need to have in your home before a lender will even talk to you? And what are the specific triggers, both in your personal life and in the broader economy, that should make you sit up and say, now is the time to act? Let's start with the magic number. While it varies slightly by lender and loan type, the golden threshold you're aiming for is 20% equity. Think of it as the key that unlocks the best refinancing options. When you have at least 20% equity in your home, meaning your loan balance is 80% or less of your home's current appraised value, lenders see you as a much safer bet. This is called having an 80% loan-to-value ratio, or LTV. Why is this 20% figure so important? Two huge reasons. First, it's the point at which you can finally say goodbye to private mortgage insurance, or PMI. If you put down less than 20% when you first bought your home, you've been paying that extra fee every single month. It's insurance that protects the lender, not you, and it can add hundreds of dollars to your payment. Refinancing once you cross that 20% equity line is one of the most direct ways to eliminate PMI and instantly lower your monthly bill. Second, having that significant equity stake makes you a prime candidate for the most competitive interest rates. The more skin you have in the game, the less risk the lender takes on, and they reward you for that with better terms. So if you're not sure where you stand, get a rough estimate of your home's current value and compare it to your mortgage statement. If you're close to or over that 20% mark, a major door has just opened for you. Now let's talk about the triggers. These are the life events and market shifts that should act like a giant, flashing sign telling you to investigate refinancing immediately. We'll break them down into two categories: personal triggers and economic triggers. First, the personal triggers. These are all about changes in your own life. The number one personal trigger is a significant improvement in your financial health. This usually comes in two forms: a major income boost or a big jump in your credit score. Let's say you got a promotion, a big raise, or your spouse went back to work, substantially increasing your household income. This is a game changer. Why? Because it drastically improves your debt-to-income ratio, or DTI. Lenders are obsessed with DTI. A lower DTI means you have more monthly income available to handle your debts, making you a much more attractive, lower-risk borrower. That income boost could be the very thing that qualifies you for a top-tier interest rate that was out of reach before. Equally powerful is a dramatic improvement in your credit score. Maybe when you first bought your house, your credit was just okay, say in the 640 to 680 range. You got a mortgage, but you definitely didn't get the best rate. But since then, you've been a financial rock star. You've paid every bill on time, paid down credit card balances, and haven't opened any new unnecessary accounts. Now your score is a stellar 780. The difference between a mortgage rate for a 660 score and a 780 score can be massive. We're not talking about a few dollars a month. Over the life of a 30-year loan, that difference could easily add up to tens of thousands of dollars in saved interest. If you've done the hard work to rehab your credit, refinancing is how you cash in on that effort and claim the reward you deserve. The second major personal trigger is the need for a large amount of cash. Life happens. Maybe you need to pay for a child's college tuition, you have a brilliant idea for a business you want to start, or you want to do a major home renovation that will significantly increase your property's value. Or perhaps you've racked up high-interest debt on credit cards or personal loans. This is where a cash-out refinance becomes a powerful strategic tool. Instead of taking out a personal loan at 15% or carrying a credit card balance at 25%, you can tap into your home's equity. You refinance your mortgage for more than you currently owe and receive the difference in a lump sum of cash. Because mortgage rates are almost always far lower than other types of debt, you're essentially consolidating that expensive debt into a single lower interest payment. It's a way to leverage the asset you already own to solve other financial challenges in a much smarter, more affordable way. A third, and very urgent, personal trigger is an upcoming adjustment on an adjustable rate mortgage or ARM. If you have an ARM, you enjoyed a low fixed teaser rate for the first few years, maybe 3, 5, or 7 years. But that introductory period has an expiration date. When it ends, your interest rate will adjust based on the current market rates, and your monthly payment could suddenly jump by hundreds, or even over $1,000. This is not a situation you want to be caught off guard by. If you are a year or even 6 months away from your first rate adjustment, you should be treating it like a ticking clock. This is the perfect time to refinance out of that unpredictable ARM and into the safety and stability of a fixed-rate mortgage. You'll lock in a predictable payment for the life of the loan and be able to sleep at night, never having to worry about market volatility causing your housing payment to skyrocket. Beyond these, there are other life events like a divorce, which often necessitates refinancing to remove one spouse's name from the loan and deed, allowing the other to keep the home. The key is to recognize that your mortgage isn't set in stone. It should adapt as your life changes. Now let's zoom out from your personal life to the wider economy. Economic triggers are just as powerful, and sometimes they create a perfect storm of opportunity. The most obvious economic trigger is a significant drop in interest rates. This is what everyone waits for. When you hear news anchors talking about the Federal Reserve cutting rates and mortgage rates hitting historic lows, that is your signal. The old rule of thumb was to only refinance if you could lower your rate by at least 1 full percentage point. But that's outdated advice. With today's larger loan amounts, even a 0.5% drop can result in substantial savings, especially if you plan to stay in your home for many years. The key is to calculate your break-even point. Divide your total closing costs by your monthly savings. That tells you how many months it will take to recoup the cost of refinancing. If you plan to be in the house longer than that, it's almost always a financial win. The second major economic trigger is a hot housing market. This might sound counterintuitive, but think about it. When home prices in your area are rapidly increasing, your home's value goes up with them. This means your equity grows not just from the principal you're paying down, but passively through market appreciation. This can be the catalyst that pushes you over that magical 20% equity threshold we talked about. Maybe a year ago you only had 15% equity, but a 10% jump in local home values just pushed you to 25%. Suddenly, you're in a position to drop PMI or have enough equity to do that cash-out refinance for a home renovation. A rising market builds your wealth on paper, and refinancing is the mechanism you use to turn that paper wealth into tangible financial benefits, like a lower payment or cash in hand. So you've identified your trigger. Your personal finances are in order, the market conditions are right. You're ready to pull the trigger. But what happens next? What are the hidden landmines in the application process? What are the closing costs that nobody talks about, and how can they derail your entire plan? And what's the one mistake that costs homeowners thousands? A mistake that's incredibly easy to make if you don't know what to look for. Let's pull back the curtain on the entire refinance process, starting with that one single catastrophic mistake. That mistake isn't a complex financial miscalculation. It's an assumption. The assumption that the first offer you get is the best one you can get. It's the assumption that your current lender, or that friendly-sounding person on the phone, has your best interests at heart. This single assumption, this failure to do one simple thing, is a financial leak that has cost American homeowners not just thousands, but tens of thousands of dollars over the life of their loans. We'll expose exactly what that is and how to avoid it. But first, you need to understand the battlefield you're stepping onto. The application process. Think of the refinance application not as filling out forms, but as building a case. You are the lawyer and the lender is the judge. Your case is simple. I am a responsible, reliable borrower, and lending me hundreds of thousands of dollars is a safe and profitable bet. To prove this, you need evidence. This evidence comes in the form of documents, a collection of papers that tells your entire financial story. First, the lender wants to know your story of income. This is your proof of ability to pay. If you're a W-2 employee, this is straightforward. You'll need your most recent pay stubs, usually for the last 30 days, showing your year-to-date earnings. They'll want your W-2 forms from the last 2 years to see a consistent history. And they'll almost certainly ask for your last 2 years of federal tax returns, all pages, not just the summary. They are looking for stability. They want to see a reliable stream of income that isn't going to dry up next month. If you're self-employed or a business owner, your case gets more complex. You're not just providing a W-2. You're providing the entire financial health report of your business. This means 2 years of business tax returns, profit and loss statements, and balance sheets. They will scrutinize this, looking for trends. Is your income growing? Or is it shrinking? Your job is to present a picture of a thriving, stable enterprise. Next, the lender needs to understand your story of assets. This is your safety net. What do you have in reserve if things go sideways? You'll need to provide bank statements for the last 2 months for all of your accounts: checking, savings, investment accounts, retirement accounts like your 401k or IRA. They're looking for a few things here. First, do you have enough cash to cover the closing costs? Second, do you have reserves? Lenders like to see that you have enough money in the bank to cover a few months of mortgage payments, even if your income stopped. It's a sign of financial prudence. A word of caution: lenders are wary of large, recent, undocumented deposits. A sudden $50,000 deposit looks like a red flag. It could be an undisclosed loan from a family member, which is a debt they don't know about. If you have legitimate large deposits, be prepared to source them with a paper trail. Finally, they need your story of debt and credit. This is your track record, your financial DNA. You'll provide a list of all your debts: car loans, student loans, credit card balances, any personal loans. But the real star of this show is your credit report and score. The lender will pull a comprehensive report from all 3 major bureaus: Equifax, Experian, and TransUnion. They will look at your FICO score, your payment history, how much of your available credit you're using, and if you have any bankruptcies or foreclosures. This single report is the most powerful piece of evidence in your case. A high score says you're reliable. A low score says you're a risk. Once you've assembled your case, you submit it. The lender's underwriter, their chief detective, then begins the process of verification. They will verify your employment with your employer. They will verify your bank deposits. They will order an appraisal of your home to confirm its value. This part feels slow and intrusive. Feels like a financial colonoscopy. But every request for another document, every question, is just the judge examining your evidence. Your job is to be prompt, organized, and honest. Now, assuming your case is strong and the underwriter gives you the green light, you're approved. This is the moment of relief, but it's immediately followed by a moment of shock for many: the closing costs. These are the silent killers of a great refinance deal. Everyone focuses on the interest rate, but they forget about the mountain of fees required to actually make the new loan a reality. Closing costs typically run between 2 and 5% of the total loan amount. On a $400,000 refinance, that's anywhere from $8,000 to $20,000 out of pocket. So what are you actually paying for? Let's break down the biggest culprits. First, the origination fee. This is the lender's fee for creating the loan. It can be a flat fee or a percentage of the loan, often around 1%. Think of it as their main paycheck for doing the work. Then there's the appraisal fee, usually $400 to $600. This pays a licensed appraiser to come to your home and determine its current market value. The bank needs to know that the asset they're lending against, your home, is actually worth enough to cover the loan if you default. Next up is title insurance and a title search. This is a big one, often costing over $1,000. When you refinance, the new lender needs to be in the first lien position, meaning if you sell or foreclose, they get paid first. A title search scours public records to make sure there are no other claims, liens, or judgments against your property. The title insurance is a policy that protects the lender in case the search missed something. It's a mandatory protection for them that you pay for. You'll also see a laundry list of smaller, but significant fees: credit report fees, flood certification fees, attorney or settlement fees, which pay the professional who orchestrates the final signing, and government recording fees, which is the cost to have your new mortgage officially recorded in your county's public records. When you see all of this on a document called the loan estimate, it can be overwhelming. And it's here, in this moment of complexity, that most people make that critical $1,000 mistake we talked about. They see the fees, they see the approved interest rate from the first lender they spoke to, and they just accept it. They don't want the hassle of starting over. They feel like they're already too far down the road. That is the mistake. Not shopping around, We spend hours researching a $500 television to save $50. We clip coupons to save $2 at the grocery store. Yet when it comes to the single largest financial instrument in our lives, a decision worth hundreds of thousands of dollars, we often take the very first offer we receive. It's a psychological trap. The process is intimidating, and the first lender who gets you pre-approved feels like a trusted partner. But they are not your partner. They are a business, and their goal is to maximize their profit on your loan. Let me put this in real numbers. Let's say you have a $400,000 mortgage. Your current lender offers you a refinance at 6.5%. It's better than your old rate, so it feels like a win. You're tempted to just sign. But you decide to spend one afternoon making 3 other phone calls and filling out 2 more online applications. Lender B comes back at 6.375%. Lender C comes back at 6.25%. That difference between 6.5% and 6.25% seems tiny. It's just a quarter of a point. But what does it actually mean? On that $400,000 loan, that quarter of a point will save you over $70 every single month. Over the 30-year life of the loan, you will save over $26,000. $26,000 for a few hours of work. Failing to shop around is like walking into a car dealership and saying, "I'll take the first car you show me at whatever price you write on the sticker." You would never do that. Yet millions of Americans do the equivalent with their mortgage. They leave tens of thousands of dollars on the table out of convenience or intimidation, or a misplaced sense of loyalty. The single most powerful tool you have as a borrower is competition. But comparing offers isn't as simple as looking at the interest rate. Lenders use specific tactics and hidden fees in the loan estimate to make their deals look better than they are. How do you decode this document? What are the 3 red flags on a loan estimate that should make you run, not walk, to another lender? And how can you use competing offers to make lenders fight for your business, getting you a deal that wasn't even on the table to begin with? Let's pull back the curtain on that piece of paper, the loan estimate, because this is where the game is truly played. This document is designed to let you compare apples to apples, but some lenders are experts at making their Granny Smith look like a Honeycrisp until you take a bite. The first red flag is what I call the origination fee shell game. You see a fantastic rock-bottom interest rate advertised. It looks incredible. But when you get the loan estimate, you look at Section A, origination charges. And there it is, a massive fee. $2, $3, even $4,000 listed as an origination fee, processing fee, or underwriting fee. What they're doing is buying down the rate with your own money and calling it a fee. A truly great deal has both a competitive rate and low origination charges. If a lender is charging you a hefty fee in Section A, they're not giving you a great rate, they're selling you one. Your first question to any lender should be, what are your total origination charges in Section A? If that number is shockingly high, it's a giant red flag. The second red flag is the deceptive use of discount points. Now, points aren't inherently evil. 1 point typically costs 1% of your loan amount, and it permanently lowers your interest rate. The red flag isn't the existence of points, it's the lack of transparency. A lender will quote you an amazing rate, say 5.5%, but they forget to mention that this rate requires you to pay 2 points. That's $6,000 on a $300,000 loan, out of pocket at closing. You need to look at Section A of the loan estimate again, specifically the line item for points. If you see a number there that you didn't explicitly discuss and agree to, stop. You're being misled. The key is to calculate your break-even point. If paying $6,000 in points saves you $100 a month, it will take you 60 months or 5 years just to break even. If you plan on staying in the house for 10 years, it might be a great deal. If you might move in 3 years, you just threw thousands of dollars away. A lender who isn't upfront about the cost of points is not a lender you want to trust with a 30-year commitment. The third red flag is the most subtle, and it shows you a lender's true character. It's the lowball third-party estimate. Scroll down your loan estimate to Section B, services you cannot shop for, and Section C, services you can shop for. These are things like the appraisal fee, the credit report fee, title insurance, and settlement fees. Now, the lender doesn't set these prices directly, but they have a very good idea of what they cost in your area. Shady lenders will deliberately put unrealistically low numbers here. They'll estimate the appraisal at $300 when they know it's closer to $600. They'll put title fees at $1,000 when the real cost is double that. Why? Because it makes their total closing costs on page 1 look much lower than the competition. They're winning your business with a fantasy number, knowing full well that by the time you get the final closing disclosure right before you sign, those costs will magically inflate. And at that point, they assume you're too far down the road to back out. A lender who is honest and transparent will give you a realistic estimate of these costs from the very beginning. If one lender's third-party fees look too good to be true compared to 2 or 3 others, they almost certainly are. Now that you can spot the traps, let's go on the offensive. This is how you turn the tables and make lenders compete for your business. The power in any negotiation comes from having options. You must, and I cannot stress this enough, get a full official loan estimate from at least 3 different lenders. Not a quick quote over the phone, not a pre-approval letter. The legally binding loan estimate. Once you have your 3 estimates, you become the general manager. Lay them out side by side. Look at the key metrics. The interest rate, the APR, the total origination charges in Section A, and the total cash you need to close. Let's say Lender A has the best overall deal. The rate is good, the fees are reasonable. Lender B is in second place. Maybe their rate is 1/8 of a point higher or their fees are $500 more. You don't just accept Lender A's deal. You pick up the phone. You call your contact at Lender B and you say this calmly and respectfully. Hi, I really appreciate you putting this loan estimate together for me. I'm very close to making a decision. Right now, I have a competing offer in hand from Lender A with an interest rate of 6% and total origination fees of $1,000. I genuinely enjoyed our conversation and would prefer to work with you. Is there any way you can match or beat that offer? And then you do the most powerful thing you can do in a negotiation, you stay silent. Let them respond. What you've just done is transform the dynamic. You're no longer just a customer. You're a prize to be won. Lenders have what's called a fallout rate, which is the percentage of applicants who start the process but don't close with them. They hate fallout. They've already spent time and money on your file. 9 times out of 10, they will come back with a better offer. They might match the rate. They might waive a processing fee. They might offer you a credit. Once Lender B improves their offer, you now have a new best deal. What do? You take that new improved offer and you call Lender C or even go back to Lender A. Hi Lender A, thank you again for the original offer. Just to let you know, Lender B has now come back with an offer at 6%, but with only $500 in fees. I want to give you a final chance to earn my business. What is the absolute best you can do? You are now conducting a polite, professional bidding war for your own mortgage. This process alone can save you thousands of dollars over the life of the loan. For the cost of a few phone calls, you are no longer accepting the first offer on the table. You are creating the best possible offer for yourself. But what about that deal that wasn't even on the table to begin with? This is for anyone who's thinking, this is all great, but I don't have $5,000 in cash to pay for closing costs. The secret weapon is asking for a lender credit. A lender credit is the opposite of paying points. Instead of you paying the lender to lower your rate, the lender pays you to accept a slightly higher rate. They give you a credit that can be used to cover some, or even all of your closing costs. So, you could get a loan at 6% and pay $5,000 in closing costs. Or you could ask the lender, what kind of lender credit can you offer me if I take a rate of 6.25%? They might come back and say, at that rate, we can give you a $4,000 credit. Suddenly, your cash to close drops from $5,000 to just $1,000. Yes, your monthly payment is slightly higher, but you've just refinanced your mortgage with almost no money out of pocket. Lenders don't always advertise this option aggressively, because a lower rate looks better on a billboard. But for many Americans, cash flow is king. Having the ability to refinance without draining your savings account is a game changer. It's the off-menu item you have to know to ask for. So now you've dodged the red flags, you've negotiated like a pro, and you've secured a deal with the perfect combination of rate, fees, and cash to close. You're ready. The finish line is in sight. But the last 100 yards of this race are filled with the most dangerous last-minute hurdles. What is the single most important document you'll receive before closing? And what is the one costly mistake that thousands of homeowners make in the final 48 hours that can either delay their closing or, even worse, kill the entire deal right at the signing table? That all-important document is called the Closing Disclosure, or CD. And under federal law, your lender is required to give it to you at least 3 full business days before you are scheduled to sign the final papers. This isn't a suggestion, it is your right. It's called the 3-day rule, and it was put in place specifically to protect you, the consumer, from being rushed at the closing table. This document is your final official breakdown of the entire loan. It's the last line of defense against mistakes, misunderstandings, or last-minute changes. When you get your closing disclosure, you need to stop everything and compare it line by line against the loan estimate you received at the very beginning of the process. Are the numbers the same? Is the interest rate what you were quoted? Is it a fixed rate as you expected? Are the total closing costs in line with the estimate? Look at the lender credits. Did they apply the credit they promised you for choosing a slightly higher rate? Look at the cash out amount or the final cash to close figure. Is that number exactly what you were anticipating? This is your last chance to ask questions and demand corrections. A single typo or misplaced decimal point on this document could cost you thousands of dollars over the life of the loan. Don't just glance at it. Scrutinize it. If anything, and I mean anything, looks different from what you were promised, you call your loan officer immediately. Do not wait. Getting this document right is the key to a smooth closing. But that brings us to the second, more dangerous question. The one costly mistake that torpedoes more deals in the final 48 hours than almost anything else. You've done everything right. You've been approved. You've reviewed your closing disclosure. You're just coasting toward the finish line. And in that moment of relief, you make a fatal error. What is it? You change your financial profile. You do anything that alters the numbers the underwriter used to approve you in the first place. See, what most people don't realize is that the lender doesn't stop watching you after they issue that clear to close. They often perform what's called a soft credit pull, or a credit refresh, just 24 to 48 hours before funding the loan. They are doing one final check to make sure the person they approved 2 weeks ago is the same person showing up to sign today. And if something has changed, the whole deal can come to a screeching halt. So here is your critical do not do list for the 2 weeks leading up to your closing. First, and most obviously, do not apply for any new credit. I don't care if the furniture store is offering 0% financing on a new living room set to go in your newly renovated house. I don't care if you get a pre-approved offer for a premium travel card in the mail. Do not apply for a new car loan, a new credit card, or any kind of personal loan. A new credit inquiry can ding your score, and new debt will absolutely wreck your debt-to-income ratio, which could trigger an automatic denial from the underwriting software. Second, do not make any large, undocumented cash deposits into your bank accounts. To a lender, a sudden large deposit of cash that can't be sourced looks like a fraudulent, undisclosed loan from a friend or family member, which is a massive red flag. Every dollar needs a paper trail. If you sold your old boat, you need a bill of sale. If you received a gift, you need a formal gift letter that the lender can verify. Don't just move big chunks of cash around. Keep your accounts as boring and predictable as possible. Third, do not change jobs. Even if it's for a promotion and a huge raise, your loan was approved based on your current employment history and income stability. Changing employers, even for the better, introduces a new variable. The underwriter has to re-verify everything, and if you're moving from a salaried W-2 position to a commission-based or self-employed role, it can kill the deal entirely. Wait until after the ink is dry and the loan is funded. Fourth, do not co-sign for anyone. Not for your kid's first car. Not for your cousin's apartment lease. When you co-sign, you are legally 100% responsible for that debt. It immediately appears on your credit report and is factored into your debt-to-income ratio, even if you never personally make a single payment. And finally, don't max out your existing credit cards. People think as long as they don't open new accounts, they're fine. But your credit utilization, the ratio of your balances to your credit limits, is a huge factor in your credit score. If you go on a spending spree and run your balances up right before closing, your utilization can spike, your score can drop, and the lender might pull the plug. In short, for those final 2 weeks, you need to become a financial ghost. Keep a low profile. Pay your bills on time, use your credit as you normally would, and don't make any sudden moves. The time for big life changes is after you have the keys and the new lower mortgage payment. So where does that leave us? We've journeyed through this entire, complex world of refinancing. From understanding your why, to calculating your break-even point. From the crucial difference between shopping for rates and shopping for lenders, to decoding the hidden costs in your loan estimate. We've talked about the power of cash-out refinances to strategically eliminate high-interest debt, and the discipline required to make a shorter-term loan work for you. And now, you know how to navigate the final critical days before closing without making a catastrophic mistake. Refinancing a mortgage is one of the biggest financial decisions you will ever make. But it's not just a transaction. It's not just about lowering a payment. It's a strategic tool. It's about taking control of your single largest asset and making it work harder for you. It's about freeing up thousands or even tens of thousands of dollars that you can then use to invest, to save for retirement, to pay for college, or to finally achieve a level of financial peace you've only dreamed about. The housing market will always fluctuate. Interest rates will go up and they will go down. But the principles of smart financial management are timeless. Knowledge is your shield. Preparation is your sword. By watching this, you've armed yourself with the information that separates the successful homeowner from the one who leaves money on the table, or worse, gets taken advantage of. You now understand that the lowest interest rate isn't always the best deal. You know to look at the APR and the total closing cost to see the true picture. You know that your home equity is a powerful resource that, when used responsibly, can be a launchpad for building real generational wealth. So I want to thank you for taking this journey with me. If you found even one piece of this information valuable, if it cleared up some confusion or gave you the confidence to take the next step, do me a favor and hit that like button. And be sure to subscribe, because our goal here is to continue demystifying the world of finance, turning complex topics into simple, actionable strategies that you can use to build a better future. And now I have a question for you. After everything we've covered, what was the single most surprising or useful thing you learned about the refinancing process? Drop your answer in the comments below. I read every single one, and your feedback helps me create better content for this entire community. Remember, your home is more than just a place to live. It is a financial engine. Learn how to operate it and you can go anywhere you want.